One of these days we just have to start wearing the hats. Like it's there every time. Just got to put it on.
And we need
It's
to
just the speaking hat. We'll just pass it back and forth.
that's smoking.
Hello, everyone. Welcome to the Nasdaq Dorsey Wright podcast for the week ending on May 2nd. I name's Ian. Lucky to be joined again here by Miles. Miles, we're recording this on Thursday morning, May 1st. Interesting April.
It has been. Would you believe it if I told you that the S&P 500 was down less than 1% over the month of April?
No, I mean, you asked me right before we hopped on here, and I said I was close. I said 1.5%, but what was it, 0.7?
0.76 to the
Yeah.
to the dot.
And so we see the S&P now after movement over the last month. I mean, we saw the S&P top out at like a 6,100 level in its default chart, turn around, gave three consecutive sell signals, big move lower down to the 4840 level, got close to, but did not touch that trend line that's been in place now for a little while, since I guess it's November 23. Turned around, more consistent improvement, triple top breakout right at the end of the month, and now we're back in the middle of its trading band.
Right. I mean, just as planned, right? I mean, like, we're sitting there and it's
Just like
like,
you planned it.
you'll see 15% drawdown, 10. Now we're going on, what is it, eight days, at least at the time of this recording. Things could change tomorrow, or by the time
Things
you're
could
listening.
change the next
It could
hour.
be 9 by the time you're listening, or it could be maybe in the future. We're
Yeah.
still going. But point being, I mean, you've seen a swift rally off of the bottoms. There's a couple, I'll make a very quick bull and bear case just for the S&P 500. Nice support offered well above those 2025 lows around 5150 on the default chart. If you're a bear in the room or bear listening, we're around the middle of the trading band, around that 50-day moving average, and we've got resistance levels baked in between 5750 and around 5650. So we could be seeing some near-term headwinds as we come off of this kind of breadth thrust from here.
Yeah.
So that's maybe a bull and bear case.
Yeah, and I think John was in talking with John yesterday on a company call. He was talking about how we really kind of need to see these broader indices push back to highs if we're going to see kind of confirmation, right? We saw domestic equities fall out of the top position in our Dolly asset class rankings during April. Commodities declined in strength, but not as much, so it moved up into the first place spot. I mean, domestic equities is in second. It's no longer the leader. We need to see confirmation from these areas going back to highs, making new highs. If that doesn't happen, that is where things kind of get questionable as we move into the summer. Really, is kind of what it's looked toward. But I think you kind of laid it out well there. I mean, we've seen you mentioned breadth improvement. We've seen some breadth changes over the course of the past couple weeks specifically. Obviously, a big washout move, but movement that was already going lower. You look at a chart like the PTSPX, percent positive trend for the S&P 500, the percentage of stocks in the S&P that are trading in a positive trend on their default charts.
Long-term indicator, by the way.
Long term doesn't change very often. Typically see like a few column changes a year.
Right.
The important things to note on this chart are what level are we at and what column are we at? Are we moving higher or lower, and where are we on the field?
Are a lot of stocks in positive trends or not?
Yeah. And this is helpful to be used. A lot of people are like, oh, when it reverses from extremes, like, sure. But this reached a peak in September of last year at 80. Begin moving lower in, what was that, November, actually, and continue to fall from 80 all the way down to 32% in April. So even though the market was rallying after the election, even though we got a strong start to the year that turned back around pretty quick, less stocks were in positive trends. This thing was falling. We're showing declining breadth from a longer term perspective. Carrying over to that story of the big stocks holding up the market, this thing was moving lower, right?
Right. Yes. No, that's a very good point because you look at 2023, which was a productive year for markets. This relatively was at relatively low levels. That's because we had the support of those big Magnificent Seven stocks. Think about what happened at the beginning of 2025, right? We had seen a rotation out of those, and really at the end of 2024 as well. We had seen a rotation out of those big areas. We lost the generals, right? We typically think about this and talk about it like a general soldier conversation where, if the generals of the battle don't have the soldiers behind them, they will die. to put it, I guess, morbidly. But I mean, point being is that, we've seen this, and without those leaders in 2025, sans the last, week or so off of this rally, yes, participation had waned significantly, falling below a pretty key level of 50%, right?
Right. Yeah. And we see that 50% level as kind of like a line of demarcation, line in
Right.
the sand, right? It's not that most bullish market environments occur when this is above 50. So
Right.
like the bulk of your returns, if you only invested in the S&P 500 when this thing was above 50%, you generally match the market. You're a
Right.
little bit worse, but you generally match the market. Versus obviously if you only invest in it when it's below 50%, not a great strategy. What has been a good strategy historically is the buying the market when breadth indicators reverse higher, typically. Gets washed out, you get a reversal up. I mean, just from a psychological perspective, it's a good route,
Right.
right?
Yeah.
Wash out, buy, hopefully around the bottom, market continues to move higher. We saw this
Easy as
thing,
that,
yeah,
right?
easy as pie, right? That's it. That's a podcast. We're good. We saw this thing fall to 32%, reverse up to 38% with market movement on Wednesday of
Right.
this week. Which actually, when we look at the numbers, and I think it was David that put this in the report yesterday, right?
Joseph.
Oh, Joseph put this in the report yesterday. Looking at, we've separated it off into quintiles. So what column are we in, and then what quintile of the chart are we in? And actually, when it's in this kind of middle to low field positioning, you want to see it improve quickly out of that. It's not great when it's in that environment, right?
Yeah, and this makes sense, right? What you want is markets to make a choice, right? You want to say, hey, are we super hot right now? Are we running, right? Do we have a lot of momentum? Do we want a lot of stocks and positive trends? Yes. Oh, then that's a good market environment. Or, hey, are we super washed out, right? Are we at COVID level lows? Are we, at points where less than 20% of stocks in the S&P 500 are in positive trends? Well, are we below that point? Well, then we're probably pretty washed out. But point being, a market that can't make a decision whether it wants to go up or down, right? You call it kind of no man's land in between around 30 or so and around 60. So kind of that middle portion there. Markets are a little bit confused, right? They don't necessarily have all the soldiers on the field, but they don't necessarily have enough to just go retreat,
More
right?
soldiers are coming back, but there's not enough yet.
Exactly. Yeah. And maybe we can kill the kill the
Kill
the general soldiers analogy for now. I'm beating it to death. But that's the point, right? We really want to see us thrust higher, or ultimately, I'm not rooting for a decline here, but it wouldn't be historically abnormal to just go down and wash out, if that makes sense.
Yeah, and for those that are like, we'll throw the charts up on YouTube, but for those that are listening and not watching, I mean, you're looking at average if it's in the O's from that 30 to 60 or in X's from that 30 to 60 range. So in X's from 30 to 60, which is where we are now, wide 30 point swing. I mean, if it's in X's from 30 to 40, you're on average down 2% over the next year. If you're and hit that 40 to 60 range, kind of bouncing around 50, your average up 2% over the next year.
Right.
A lot more instances around that 40 to 60 range. So I will note that there hasn't been that many days that we've seen this thing sit in X's between 30 and 40.
Right.
It will move out of that probably. It's just a matter of if we're going to continue up higher and then maybe try to continue up out of that 60 range, or if it's going to reverse back lower. Right.
And maybe this is a good transition. We have got a bunch of different indicators that can help us determine ahead. We don't want to just wait for a reversal back down for the PTSPX to see if we're going to go lower, right? We can watch some of our near-term indicators to see what direction things might be heading. And so you and I were talking about a couple before, the advanced decline ratio.
Yeah, I've seen a lot of conversation around on the financial media sphere about the advanced decline ratio, the advanced decline lines for the NYSE specifically. Looking at the percent of or the advancers relative to decliners, and from a compounding perspective, reach strong levels. We got kind of a historic breadth thrust conversation. Another way that we can look at it on our platform is we call the NYSE advanced decline ratio. It's not anything new. We're just plotting a ratio rather than a compounding value that just looks at what's the relative advancers to decliners. We fell all the way down to 36% in April. So that's low on this chart. We
Right.
got there, but we were there at 36 in December of last year was the last time we fell down to that level.
Mhm.
We've also down typically the below 40 a lot of times tends to mark some kind of bottom over the course of the past couple of years.
Right.
On the other, and then after the that 10% up day in early April, we reversed course, went straight back up to 62% chart level. Which getting above 60 a lot of times kind of marks the kind of
The topping portion.
environment. And it's not to say that if this thing can't move higher, we're going to see markets move lower. And it's not to say if it reverses down, markets are going to move lower. It's just saying that we're at the potential, at least pause in a breadth environment.
It would make sense. Let's put it that way, right? It would make sense as I kind of go back to the S&P 500 call out from the beginning of the call. We're nearing some resistance. We're seeing a somewhat, not necessarily a topping formation, if you will, but we look at some of the near-term indicators. They are reaching relevant highs that they might just need to take a break. We're also going forward for 8 straight days now. It just makes sense.
Yeah, we saw an extremely sharp shock to the market in a very short time perspective after Liberation Day. And then subsequently over the next week or two, we saw a very quick rebound from the market, saying it exhaustive selling and then exhaustive buying coming back into play. And now have we exhausted it? This thing can go higher. I mean, we got all the way up to 68% in early 2023. We touched 70 during the COVID rally in June of 2020. I mean, so we can definitely see this thing move higher, but it's just a matter of a lot of stuff has been moving up, and it would make sense for some kind of a pause in the improvement.
And that, again, that you don't necessarily, you can make that call without sounding bearish. You can just say, okay, well, I think that it just makes sense for a little bit of a relaxation. It's not great to see markets going up every single day as much as we
Well, it feels
think
good.
that it is. It certainly does, but it would get a little weird after a little bit. It would be like, well, this market's just up, up, up,
Yeah,
up.
it's funny. I'd go home and for a bit for when markets were red every single day.
Yeah.
That feels bad. I'd
Yeah.
go home. Fiance was like, "Oh, how was today?" I was like, "Bad day to be a stock," right? I mean, so it's a lot better when stocks are going up, right?
Right.
But it wouldn't be the end of the world to see some more normal movement,
Yeah.
see some consolidation. I mean, we're in a very uncertain environment. A lot of stuff playing into movement in the market, and that's why we have these indicators and stuff to kind of follow. We're seeing domestic equities fell out of strength, but that doesn't mean it's in the bottom half a dolly. There still can be areas of strength to look toward. Might not be the same areas of strength that we saw heading into this movement, or it may be. We've seen tech rally back pretty substantially, but it's only snapped back kind of to the where it was before.
Right.
A lot of areas, in particular, with some tech earnings reporting this week, had seen some notable technical improvements, but they're nowhere near as strong as they were prior to the decline, right?
Right. And I think a really good example of this is going to be Meta, right? And we can talk Microsoft in just a second. I think that's more exciting chart, but more along the lines of what you were just saying is Meta. I mean, strong earnings. They reported yesterday, as in the 4:30 after close. Nice results from them, but you look at that chart, they returned to a buy signal, but I don't think that that's the greatest looking chart that I've ever seen in my life. Now, well off of those highs at around 736, they're all the way down at around 600, the middle of the trading band. So again, nice snapback, as you call it, off of those lows. But in some cases, the technical picture is a bit harmed, at least enough that you should be careful.
I mean, we were still oversold up until today's 5% move.
Right.
And we still might be slightly oversold after the day's over, right?
Right.
I mean, it sold off, I mean, clear downtrend,
Right.
snap back to the middle of its trading band. To your point, not a great looking technical picture, better than we were, but better than we were a couple of weeks ago, but
Yeah.
not as good as we were in January, February.
Right.
Yeah.
And I'll say this, when clients call in and they're like, oh, it's a 3. Well, one of my favorite lines is, I've seen better looking 3s. You know what I mean? So like, this is technically fine to hold, but this is one where it's like, if we get a rejection of the middle of the trading band and we start to see this kind of continuation of that very firm, we're not in a negative trend, but if we, you look with your eyeballs and see the kind of the down into the right action. If we continue to get that, I think that gets a little bit less encouraging.
Yeah, we want more consistency. This thing consolidated throughout really February into September of last year. We got back down in that range and moved out of it. We need more consistent improvement out of that range.
Right.
Right. And when you look at something like Microsoft, kind of a similar-ish picture, except a little bit more substantial weakness to the downside. We saw this thing sell off. Microsoft topped out actually back in July of last year at 464 on its default chart. Consolidation, downwards move, 4 consecutive sell signals that initially gave a sell signal in February, moved to a negative trend, moved to a weak attribute, 2 for 5 name, beat and positive reaction from earnings after the market closed yesterday at 4:30, up 9% at the time of this recording.
Right.
It has gotten a little bit more extended to the top of its trading band.
Right.
But now with kind of a similar picture to the S&P, we need to break through new highs.
Exactly. And that's why, I mean, even again, you could make a bull and bear case here, but
There's always a bull and bear case.
of course, right. But I mean, break past that resistance, break back into a positive trend, go back to technically actionable. But again, to your point, we are going to be heavily overbought off of the resistance, right? And so, does this come into play where suddenly, we're revisiting this 5 months from now and we still can't crack 440, 450 because that's just a level that we couldn't get past after a strong earnings, break back into a positive trend, and ultimately can't attack those highs from earlier last year.
Yeah.
I don't know. I'm just talking here, but
Well, yeah, I mean, Apple's another name. They're reporting earnings after the close today.
right.
So by the time this comes out tomorrow, there'll be results. We don't know what those results are going to be. Apple's shown a little bit more consistent improvement on its default chart, though. It fell to a 3 for 5 attribute rating. If it's on the precipice of moving back to a buy signal and a positive trend, we need to get to 220 for that move to happen.
Jeez, that's an interesting chart.
So if that goes up to 220, all of a sudden we're back in a positive trend. We're 4 for 5 attribute name. Similar story to Microsoft that I'd like to see it push through highs, but it has at least shown more consistent improvement, which gives us more support on the downside.
Right.
If it does move lower, supports initially at 190, 184, and then all the way down to those 170 lows. But consistency is the name of the game across what we're looking for. Apple's shown a little bit more consistent improvement over the past couple weeks. Hopefully that continues after earnings today, but I guess we'll see.
Yeah, you'll see, or we'll see.
Yeah.
But yeah, I mean, and then it just leads to the question, and we can wrap up here. But is AI back? I mean, there's a lot of
Did it ever leave?
Well, yeah, I think it did. I think we could definitely say that it.
That's
that
what it wants
did
you to
for
think.
back. Yeah, now it's back. But you would take a look at a chart like AIQ,
Right.
just as a kind of a representative for this space. Very interesting technical picture. I mean, we got a boatload of them today, but 3.76 fund score, so still technically actionable, but with a negative score direction, well off of the highs, down about 3-ish% with action, intraday action here, and testing its trend line. Again, we'll throw it up on the screen, but testing its trend line at the middle of the trading band. That seems to be a major theme, right? We're testing trends at the middle of the trading band. Would we call this an inflection point, maybe?
Yeah, I mean, it's similar to like we were just looking at for Apple, right? I mean, you look at this, Apple's the fourth biggest name in this, but you look at Tencent, Alibaba, Samsung, a lot of international stuff.
Right.
That's also in here for AIQ. And I think again, we've seen a little bit more consistency for this. It's just back at the middle of its trading band, breaks back through to a positive trend. That could be a good sign or good tailwinds for the space. But similar story to like we were looking at with Meta, honestly, and a lot of these big stocks are going to look similar. You get a consolidation period throughout some point in 2024. The stock moved down into that consolidation range during the recent decline, and now it's attempting to break out higher.
Right.
We need consistent movement above those ranges if we're going to see further strength from AI, from tech, from these big names moving forward.
And as always, keep an eye on the charts, set alerts on these types of things because there's a lot of headlines out there. There's a lot of emotions driving markets. We didn't even get to any of the presidential stuff or tariff stuff today.
We'll
That's
save
okay.
that.
We'll save it. We can do a whole 7 more podcasts probably.
There we go.
But regardless, Ian, it was a pleasure.
Yeah.
Great podcast today.
As always. Yeah. Thanks everyone for tuning in. We'll be back next week.